Murphy and Associates. They've got very interesting approaches to insurance, and Kyle's a great networker and a good friend. So take it away, Kyle.
Thanks, Eric. Okay, perfect. So hopefully you guys can see question 1 of our 4 questions in the polling. And I think we're going to keep it open for like a minute, but so far most of you have already voted. And this was good for me because we wanted to make sure that the content we're providing today wasn't something that everybody already knew. So we see a lot of slightly familiar, about half of you are slightly familiar with search funds, a third are unfamiliar. So this is good news for me. If Connexus can stop sharing their screen, I'll go ahead and share mine, or maybe I can just do it without waiting on you. I don't know. There we go. Now I'm going to share our screen and the content today. Can I get a thumbs up if we're seeing the presentation in full mode there? Perfect. Okay, so we're, Eric introduced me, Kyle working, I'm with Holmes Murphy office here in Dallas, big sponsor and supporter of FEI, believe a lot in the community that we've created here. And we're also sponsors of, as Eric said, of this private equity SIG. It's been around for a couple of years. I have not done my part in providing good content yet. Some of the other sponsors are more involved in private equity than I am. But I had an idea when we were looking for content for today's session and thought it would be interesting to do a topic on search funds. And so knowing that the responses so far on question 1, there's a slight or unfamiliarity with it, I'm excited for what we have to put together. Give you a little bit of background on how we got here. So I first found out about search funds maybe 3 or 4 years ago when I was introduced to Dan Henn, who's now a good friend, and you guys are going to meet him later in the presentation. But Dan at one time was a searcher, and you'll learn what that is. And eventually he found what he was searching for and got to spend the next 5-6 years operating that. So I don't want to steal his thunder. But we're going to have 3 speakers today, and they're going to go in the order that you see them on the screen. And first, you're going to get to hear from Dan Dowd, and I'll introduce him in a second. He's currently actively in what we call a search. And again, I'm not going to steal his thunder, so I'll let him talk about what that is. But we wanted to provide a perspective of someone who's currently in that mode of searching. And then we're going to introduce Lou Davies, who is an investor in this space and has a lot of experience over decades in this space and other spaces too. So we'll let him talk about his firm and where they invest in their time and resources and their perspective, or his perspective, on this search fund community and ecosystem. And then we'll wrap at the end of the content today with letting Dan talk about the full kind of soup to nuts journey from when he used to be sitting in Dan Dowd's shoes to now he's somewhat kind of sitting a little bit in Lou's shoes and all the above. So I think you'll get a full spectrum of the search fund community and what this is as an investment vehicle for an entrepreneur looking to become a path to a CEO. So without further ado, I'm going to introduce Dan Dowd, and I'm going to let him introduce himself and give a little bit of his background and also educate us a little bit on a high level of what is a search fund and how they historically performed from an investor perspective.
Great. Yeah, thanks, Kyle. And thanks everybody for having me on here. Excited to tell you about what I'm up to. It's probably helpful if I start with just a bit of my background, which is to say, I've sort of spent most of my career leading up to this past year with very large professional organizations. I was with Goldman for a little bit as an undergrad. I'd spent 5 years after college with General Electric in a variety of corporate finance roles in their industrial businesses. I went from there to get an MBA at Northwestern University and their Kellogg School of Management, and sort of went there knowing that I wanted to try to go do something a bit, more strategic, a bit broader, and so found my way to Bain & Company, which is a very large management consultancy, sort of like a McKinsey or a Boston Consulting Group. And I spent 5 years there from 2015 to 2020, primarily advising very large private equity funds. Think Bain Capital, Advent, CVC, KKR, by conducting diligence on assets that they were looking to acquire, or sitting inside of their portfolio companies, helping their leadership teams develop and execute value creation plans. And man, intense 5 years, loved the work I was doing, was sort of staring at the path to partnership, which, was probably 2 to 3 years out, and sort of came to the realization that it was time for the next chapter. I'd spent the last 7 years doing the B school consulting thing, that I ultimately wanted more autonomy in what my day-to-day looked like. Wanted to frankly go test myself, take a bit of a calculated risk, right? I sort of came of age in all these very large professional organizations. Well, what happens if I go try to put some of that thinking to work? Potentially I can benefit, from some of my efforts, right? And position myself for a longer term role as an investor in a lower middle market type PE fund. And so that was sort of the ultimate impetus to leave Bain and do something else. And, coincidentally, one of my colleagues at the time had a neighbor who had done a search fund, and it sort of, went off, and a light bulb went off in my head, and said, I've heard a little bit about search funds. I should go do that. And so, I did some research. If we can flip to the next page, Kyle, I'll sort of elaborate on what a search fund is, and why it sort of pinged this light bulb in my head. But a search fund is effectively an investment vehicle where a searcher, oftentimes called an entrepreneur, will go out and raise funds from a group of investors, folks like Dan Henn and Lou Davies, and they'll raise those funds in order to go out and try to find a company to acquire, and then step into a day-to-day leadership role within that business. So think about it, the way I sort of frame it oftentimes is sort of micro cap private equity that is not portfolio based approach, but instead single asset approach. And so you can take an approach that is unique relative to most other sort of investment vehicles that are out there. And search funds are not new. They've been around for, going on 40 years. They were ideated by a number of folks out at Stanford, and then supported by further ideation out of Harvard Business School. And you can see on the right-hand side, they sort of just steady Eddie for 20, 25 years. And then all of a sudden we get into 2000s and they really start to take off. And frankly, they go almost vertical over the last 5 or 6 years. And I think it speaks to frankly the community that's evolved around search funds, but also just the general attractiveness of the model, both from an investor perspective, which Lou will tell you about, from an operator perspective, which Dan will tell you about, and frankly, from my perspective, which is to say, this is an opportunity for me to go do something more my own and something on a smaller scale. And this just seemed like the perfect place to go do it. The problem when I made the decision to do this was I was about a quarter ahead of COVID. And so if we want to flip to the next page, I'll sort of give the anecdotal story there. But I made a decision to leave Bain in the fall of 2019, and it probably took me 3 to 4 months to socialize that and line everything up for Bondcliff. So we get into January, February, March 2020, and COVID starting to become a global thing. And frankly, I'm having some discussions with my mentors at Bain about, well, is now really the right time to, leave this really secure, nice job that you really actually enjoy and go take a risk, or should we go wait this thing out and, maybe recall it in a year or so? So I stepped back and do what I do naturally, which is did a bunch of analysis, went back and looked at all the search funds that formed around the last recession in 07, 08, 09. And anecdotally, this is the group of search funds that were raised. They were talking, call it 60-ish funds were raised. Anecdotally, as I talked to investors about this decision to continue with the search fund, there's a lot of really great outcomes that searchers had while raising a search fund in the last recession, frankly, riding the business cycle for the next 10 years. And so I actually got a bit more bullish about the search fund. And so pulled the trigger, left Bain at the end of March in 2020, so a little over a year ago. Ramped up my search fund, actively searching, mostly focused on generating deal flow on my own. So looking for a proprietary opportunity. So not working through traditional intermediaries like investment banks or business brokers. And have come across some really cool assets along the way, and I'm enjoying the experience of searching. And I'm fortunate enough to be in a position now where I went under exclusivity with a formal letter of intent to purchase a business that provides software to rural internet service providers. And so we're about 45 days or so into a 90-day diligence process. And it's an interesting business. I'm fortunate enough to be able to bounce it off of Lou and his team over at Cambria. It certainly is an attractive asset, but is not a traditional search fund asset on a number of dimensions. But nonetheless, exciting. I'm excited by the opportunity it presents, and am glad that I sort of stuck to my guns a year and a half ago, and went down the search fund path, despite all of the noise in the world with regards to COVID. So that's sort of a bit about me, a bit about search funds, and a bit about the last year. I know there's Q&A later, but I don't want to take time from Lou and Dan.
All right. Well, Dan, let me ask you just a couple questions. So with search funds, sometimes there's a single person that'll engage in the search. Sometimes there'll be a tag team, like a trusted partner, and the two will raise the funds and go. Did you always decide that you wanted to, kind of lead this solo on your own? Did you have a partner that you kind of kick the tires on, and would you want to do this with me? And then secondarily, oftentimes I know folks that engage in something like this kind of have a preference of where they'd like to buy a company, where they'd potentially like to live and move their family. And I'm curious what the family discussion was like of taking this risk. I'm assuming, that was part of the equation too. So maybe just talk about kind of those three components, and, how you prioritize where you were looking for deals, if that was part of it, or were you wide open to going anywhere in the US and relocating anywhere?
Yeah, absolutely. So the first question, just on partner versus solo, I don't know what the stats are, but I think it's roughly half of the search funds are raised are solo searchers and half of the funds are raised are partnered searchers. Interestingly, those that do partner searches tend to have better outcomes, I think, just because of the resourcing. And so, when I was contemplating this in the back half of 19, I did talk to two of my best friends from business school, both who went sort of similar paths as me, were consultants, one at McKinsey, one at BCG, had actually already rotated out of those jobs and were doing something different. And I think they just weren't quite at the right life position to want to take that type of career risk. And so, I continue to use those guys as sort of, sounding boards on deals, on specific things. And it doesn't preclude them from, at some point in the future, us doing something cool and fun together. It's just that the timing wasn't right this time around. And I happen to be pretty comfortable as a solo guy myself, happy to lean in and be the one running it. So I was comfortable in going the solo path, but certainly looked to do a partner path. And then, to your second point on geography, it's interesting. I think it's something like 45% of searchers who end up doing a deal do that deal in the region that they're from. And I don't necessarily know if that's because people are searching for an asset specifically in that region, or they happen to find an asset in that region. It's probably both. I went in fully acknowledging that, I want to find the best opportunity I can. And if it's in Fairbanks, Alaska, then we'll go to Fairbanks, Alaska. I grew up moving around a ton, so the notion of moving wasn't that foreign to me. And in fact, a little bit of cabin fever itch, ready to make a relo out of Boston. But the discussion with my wife was an interesting one. She was full steam ahead on the notion of search and taking on some career risk and doing something that, provides me with more sort of individual satisfaction. But the notion of picking up and moving to some unknowable place presented a little bit of anxiety. Frankly, I think it's interesting that, with COVID, we're so used to this Zoom environment that it maybe has lessened the need to be right in the headquarters location of a business, especially if the entire workforce is working remotely. And so interestingly, this asset that I'm under LOI now has a really strong existing leadership team. It's a unique asset in that the owner of it is separated from day-to-day operations. And so, there's a desire for us to be, interestingly, where this business is, but it's not necessarily a mandate of the business itself. So I think that answers your question, Kyle.
Yeah, perfect. Well, appreciate that. We'll come back to you as questions arise. I am going to introduce Lou Davies and let him introduce himself, his background, talk about his firm and his perspective on the search fund ecosystem and the industry, maybe even in Dallas, but more broad. I know they have a national reach. And then we did have a question come up. I'm going to probably save it to the end, but just wanted to acknowledge that I saw the question. I've got it written down. If you guys have other questions, feel free to send them in the chat and send them my way, and I'll log them all and we'll bring them up at the end. So Lou, why don't you take it away? Lou, are you there? You might be on mute.
There we go. Sorry about that. Kyle, I appreciate it. I appreciate you, Robert, and FEI allowing us the chance to tell the search fund story here. I am Lou Davies, managing principal of the Cambria Group, and will share the perspective of a long time and enthusiastic search fund investor. Cambria's history, I started the firm back in 1996 after working in the larger private equity world. I decided to jump down to where I thought I saw more opportunity. Our firm has 3 investment professionals. We have operating and consulting, finance, each have operating or consulting, finance and board experience. We decided to do this investing with our own capital rather than investing a fund, which we didn't think was really viable for this segment of the market. In terms of the companies we chase, as I said, we're at the lower end of the middle market. So that means for us, companies with 1 to 5 million in cash flow, we generally do much better with stable or low growth businesses than with companies growing 30, 40%, or companies that have real volatility. We are largely industry agnostic. We do stay away from a few industries for the most part, particularly construction. We lead our own deals. That was what I really started the firm to do, was to do things where we would be the sole investor and sole sponsor. But over time, because we didn't have a fund and a limited partnership agreement that told us where we had represented what we would and wouldn't do, we started doing a lot of other things. And that included search funds, backing independent sponsors, and co-investing with larger and like-sized private equity firms and venture firms. Over the 25 years, we've invested in a little over 250 platform companies, of which about 22 we have an active board role, and the balance of which are deals where someone else is doing that heavy lifting, and we're part of a consortium that's provided the equity. And we are now based in Dallas after first 19 years in Menlo Park, California. In terms of our involvement with search funds, I began talking to search funds in 1995 as I started Cambria, because they were among the groups among the concentrated groups that had a lot of experience buying and running small businesses. And I had a lot of experience buying and running larger businesses, but talked to search funds for a long time. Because we didn't have a fund, we didn't have fee income, and we thought it was unwise to sponsor someone else's overhead at the same time we were trying to cover our own. And so it wasn't until 2002 that we were convinced that we were not only doing things right, but that we could afford to back someone else's overhead. We began investing in search funds that year. We have backed in total 169 traditional searches, akin to Von Cliff that Dan runs, Dan Dowd. Of those, 40 are still active today, including Dan's. 129 have gone full cycle. Of the 129, 82 acquired a company, 42 closed, shut down without acquiring a business, and 5 had some sort of special situation, a health issue where the searcher decided to close his or her fund early, took a job. Sometimes it was a partnership split between the searchers. Other models we pursue in and around the search fund space, we probably interview 100 search funds during the course of a year and end up backing 20. So there's a big group that closes a search fund that we aren't participating in, and sometimes they get to having a deal and there's a gap in the cap table and we can fill it. We also talk to self-funded searchers and to search fund accelerators that sometimes bring in outside capital to complement what they have. And then we do, as I said earlier, back independent sponsors. Why do we do search funds? It really accomplishes 3 different things. It exposes us to a different set of companies than we would find in our normal business. Cambria, our sourcing is all opportunistic, which means that we're looking at represented deals. And search done right is very proactive, knocking on doors of companies and asking if they can buy the seller's company. And so most of their deal flow is proprietary. We think that's a great complement to what we find through our opportunistic approach. Second thing is, and when we find a company and put on our letter of intent, we are at that very moment behind the 8 ball in terms of management, because we have 90 to 120 days to get the company closed, and ideally we would have a manager in mind, but very often we don't. And so we have to not only get through diligence, documentation, financing, et cetera, but we have to find a CEO that we think is going to be viable. So that of necessity is something of a speed dating process. It doesn't always work. The search fund offers a great alternative to that, in that we get to work with a searcher over 18 to 24 months, understand how they think about risk and reward. Are they doing deep diligence, shallow diligence? Are we getting candor? Are we getting spin, et cetera? So it's a great chance to pre-qualify our manager. And then we get to share board responsibility with a consortium of investors rather than having to do it all ourselves. And that means that we get different perspectives, experience, and networks around the board table. In terms of how it's worked, I would say the original thesis for search funds really was derived around 3 elements. 1, finding a great business, typically with recurring revenues. 2nd, marrying that business with high potential, but generally less experienced executive. And 3rd, bringing in experienced investors who would provide counsel to the searcher during the search phase and then sit on the board of the acquired company. It is still a great model, I think, but all elements of that ecosystem, I think, are weakening. In general, companies pursued are less attractive in that we're finding less and less recurring revenue businesses coming, and we're seeing more repeat customer businesses. We're seeing more customer concentration. I would say prices are on balance rising as well. And that's just a matter of competitive markets, though it remains, this lower end of the middle market is clearly less competitive than most segments. It's also a matter of search funds over time have begun to migrate to pursuing larger deals, and in many cases to pursuing software deals that have entirely different pricing structures. And Dan's company he's got well along is a software business, so an example of that. I would say on balance, average quality of a searcher is declining. There's still some great searchers and lots of very good ones, but there are also some who aren't terribly qualified or well suited to the search. They may be great people, but not set to do a search. It's just a very natural consequence of anything that gets democratized. You have an averaging down. I think the investor engagement is also, to bring it home, also declining, in that you have an influx of investors who want to deploy capital in a very high return environment, but don't want to take the time to provide the input or to serve on boards. And then the traditional investor base, the people who've been there for decades, are also increasingly spread thin with boards. If you think about there being on average 100 search funds completed in a year, you've got effectively 200 to 250 search funds out there on average. And that's just hard to staff the investor side. Time to find a company is lengthening on average. Generally is going from 18, 19 months to probably 24 to 30 months now. COVID has certainly been an effect in that, but it was already moving that direction. And then last, I think the sources of equity are changing. The search fund investor base that was there is generally still there, but there's been an evolution of two phenomena. One is there are now funds of search funds. There are probably a dozen in the ecosystem that have raised funds as large as $150 million. And they are often the larger investors in a deal. And at the other side, you end up with prior searchers now investing for themselves. And in fact, they have been some of the ones who've created these funds of search funds. So Dan Henn is exhibit A for an accomplished investor becoming a high value added investor, an accomplished entrepreneur becoming a high value added investor. And I suspect Dan Dowd will follow suit with his time. In terms of an ideal investor group, we tend to think funds of funds can often bring to a searcher best practices, and they write larger checks very often in the $1 to $10 million range. Former operators and search funders, they just bring recent experience with the full spectrum of issues that are going to be faced by the searchers they're backing. And so there's a kinship there that comes. I would say otherwise, you want to find a group of people who are going to be responsive when you call. You're going to want people who are going to push back on and provide constructive criticism on your deal. I think the last thing you need is someone who's going to give you lots of attaboys and say this is a great deal and then not show up with a check at the end because they haven't really been paying attention or because they just wanted to give a good, nice feedback. So you want people who are going to be candid with you the same way as you'd want those people on your board. We tend to think investors with deal experience can be helpful. They have a lot of scar tissue that can save a searcher time. They can provide advice on financing and transactional issues. Having a mix of investors with different check sizes, again, ranging from people who want to write a few $100,000 check, but who've just been through a search, to people who can write a $1 million or $5 million check is very helpful. And then last, investors who have both the capacity to serve on a board and the willingness and interest in doing so. And people who have a mix of experience is critically important. I'll, in the interest of time, I'll skip the advertisement for Cambria, but I'd like to think our experience across 250 companies is what we're trying to bring to bear for our searchers' benefit.
Appreciate that, Lou. Quick question for you before we move on to Dan Henn. As you've seen more people come into this space and as potentially the quality of searchers is on a decline, what are the characteristics you look, if someone comes to your table and is trying to raise funds for you to say, hey, I'm going to fund the overhead of this person for 18, 24 months to go, buy a company. What are you looking for where they check the boxes where you say that's an investment or a bet I'm willing to make?
Sure. So the most important, the big check that we're going to write, that any of the investors are going to write, is going to be when someone acquires a business and needs to fund $12 million of equity. So if we're 1/12 of a search fund, our pro rata is going to be $1 million. So that key decision is going to make us focus on, do we think that if this person finds a business, they are going to be capable of running it? So we would love to see someone who has actually managed people, someone who has worked, the CEO of any small business is also its primary salesman. So we would love to see some element of sales, operations, finance, people management, and strategy experience. I think what we worry about is if we see someone who's been a software analyst and then worked in doing algorithms in a hedge fund, but think they really want to be an entrepreneur. That we will generally not do. So, and then the second question is, do we think this person can find a company? And that's a matter of, are they willing to, do we think they'll be able to appeal to sellers? Or the questions we ask about, do they give us the sense that they can get through the ruthless culling process of looking at thousands of deals and bringing it down to one that they're going to close? But the key thing, most important, is can they run a business if they can acquire it? Second most important, are they going to be successful at acquiring it?
Awesome. Thanks, Lou. We'll come back to you with some questions at the end. Let's keep moving along here, and I'm going to introduce my good friend Dan Henn, who kind of runs both perspectives that you've already seen, and we can get the full story here. So Dan, why don't you give everybody an introduction, a little bit of a background? How did you first hear about search funds and decide to take the leap, and then take us on?
Well, at the risk of putting everyone to sleep 40 minutes in, so I started my career out, did some investment banking for a couple of years, joined a private equity firm in Chicago called Prairie Capital. Was there for 3 years, helped them acquire 6 businesses, and frankly, just loved talking to entrepreneurs and found out that those were the people that I admired most. Not that I didn't like my colleagues in private equity or investment banking, but it was the entrepreneur that I wanted to be. And so went back to business school at Harvard, really with the intention of trying to find some path to entrepreneurship, and stumbled into the search fund model pretty early in those 2 years, and ultimately ended up calling a Notre Dame undergrad buddy of mine, Mike, and pitched him on doing this crazy search. He's a bare knuckle entrepreneur. He was running a parking lot management business in Detroit at the time. And I called him and said, hey, I'm going to go out and, raise $500,000 from 25 high net worth investors. And then if we're going to go out and pitch ourselves as the long lost son of a successionless business, and then we're going to get these people to give us another $10 million of equity. And he literally said, that's the dumbest idea I've ever heard. Ask Harvard for your money back. And he hung up the phone. And so that was a quick conversation. He called me back a month later and said, I know you're not that ridiculous. Like, what's going on? So I did some more education, and he signed up. We raised our fund in August of 2007. We were not nearly as smart or as thoughtful as I'm sure Dan Dowd was in his fundraising process. We just became enamored when we asked people to give us 25 grand and they said yes. We got really excited and said yes back to them. And so our fundraising process was pretty quick and painless. We raised our $500,000, and in August 2007, we set off on what is probably the worst search in the history of search. We were the least capable and did it the most inefficient way. But there is an element of serendipity in the process. And we had a very broker-centric approach, which was different than, I think, best practices as they're defined and as they are today in search. I was the only kid coming out of Harvard my year, and I guess we thought that because search was not as well known, we need to educate the world. And so we lived on Southwest Airlines flights. We would fly to places like Dallas. We would meet with accountants and attorneys and financial planners and business brokers and anybody that had a relationship with a business owner. We had about 3 jokes that were our go-to that we would tell in a 30-minute window if we got 30 minutes with people. And then we would, at the end of that meeting, run out to the rental car, drive to the next meeting, and tell the same stories all over again. It got to the point where, we had scripts basically, and Mike could fall asleep for 15 minutes, wake back up, tell his joke, and go back to sleep again. And we just did a lot of that. And there were some kind people that recognized that we were, reasonable human beings, well-intentioned, and they were nice enough to send us some opportunities. We had thousands of teasers. We probably looked first pass at about 125 or so companies. Really with 6 of those that stood out. We had the belief that, really interesting companies kind of stick out like a sore thumb. So you may see a lot of, so-so businesses, and then all of a sudden you've got a business that's growing at 15 or 20%, has 20% EBITDA margins, has customer diversity, has recurring revenue, and it's just clear that there's a really good company there. And we thought our job was to figure out, is whatever dynamics are at play in this business, will they continue forward for a period of time where we can be idiots, make mistakes, and the business is going to survive that. So we got introduced to a company in McKinney by a local investment banker, Bulkley Capital. That was in January of 2009. It took us about 7 months of pestering them to outbid the largest strategic and likely buyer of Stat Lab back then, Cardinal Healthcare. But got the business under letter of intent in July, closed on it in September, and off to the races we were. Stat Lab, when we bought it, was a regional distributor of supplies used by a pathologist to prepare a tissue sample for a cancer diagnosis. Actually, behind me, you can see Stat Lab's products on a microscope slide staining tissue. It was a great business, owned by three brothers. They got to the spot in their lives that they could be better brothers if they also weren't business partners. But they've done a great job. It had grown for 30 years, about every year. 2,000 customers, the largest of which was 8% of revenue. It's probably not technically meeting Lou's definition of recurring revenue, but it was definitely a repeat consumable products, reagents, chemicals, waxes, microscope slides, cutting instruments, all the things that a pathologist needs to run their shop. The business, when we bought it, was about 18 million of revenue and a little under 3 million of EBITDA. And we came in, we were not the brightest guys, but probably the best idea we had was, let's just not screw this up. And so we had a good board that gave us a long leash, but they also made sure that we weren't stepping in too many landmines. Got in and just tried to, help people in their jobs. And, we took out the garbage. We worked on the packing line. We did the things that build credibility with a small business. Learned the business for a couple of years. Pretty early on, we decided that we wanted to build on what was essentially a 6-person telephone sales team. And so we took that little start of a sales initiative, and my partner, Mike, really built out a 35-person direct sales force across the country. He lived in labs. He was single at the time, so he could be on planes for another few years. As we built out that sales team, we found that we really annoyed most of our suppliers, because our suppliers also happened to be our primary competitors. And they started to monkey around with us on price, on availability of product. They wanted to keep us out of different pockets of the market, hospitals in particular. And so it was a challenging time. It was a great opportunity, though, for the business, because we ended up bringing most of our products, eventually all of our products, under a Stat Lab brand. So instead of working with the largest manufacturer in a particular product category, we would go to the second or third largest player. We would work with them. It would be a Stat Lab brand, and we were off to the races. As we did that, we found that many of those suppliers were family-held businesses. They often didn't have the same appetite for growth and risk that we had. And so we got to the point where we thought we could be maybe better at manufacturing in a particular category of product. And that was around things that we could formulate and package. And so stains and waxes and reagents, and started into that path with an acquisition to basically hire a mad scientist to help us do that quickly. And then we ended up building a $10 million facility in McKinney that had a lot of interesting aspects to it, like an explosion-proof manufacturing room and tank farms with 40,000 gallons of flammable goo in the back. Most of the time, we tried to get things 80% right before we take a leap and figure out the rest. I can say that we were probably 95% right with our explosion-proof manufacturing room. And we quickly closed that last gap to get us all the way there. But that really kind of propelled the business on. We had gone through in the early years, the revenue growth was a little harder to come by as we were building out the sales team and trying to build infrastructure there. But once the team was built, revenue really started cranking, and then margin really started coming towards the end as we insourced and took over more of that manufacturing. We sold the business 8 years in. Our investors said, hey, guys, you've done a great job. We took a chance on a couple of 30-year-old knuckleheads, and it looks like it's going to pay off. The market's great. So let's sell. And we said, okay. So we sold the business 2017 for the first time to a Chicago-based private equity firm called Cressy and Company. And then Mike and I transitioned out of day-to-day roles. I actually transitioned out a bit before the sale, about a year before the sale, as part of our process. And then Mike transitioned out probably 3 days after the sale. And we rolled some equity, stuck around to help them with a couple acquisitions. And then they sold the business at the end of last year for a second time. Both were very successful outcomes. So my stature with my in-laws improved quite a bit between 2007, when I said I was going to go buy a business I knew nothing about, and 2017, when I sold a business that I knew a few things about. But that was the StatLab journey. Again, I won't go into the plug for what I'm doing now too much, but I have moved to being a day-to-day operator. I miss many aspects of running a business, building a team, celebrating wins, fighting through challenges. I have moved more into a chairman type role. So ideally looking for companies that I can own forever. I have one of those businesses now, a dermatology products business in Omaha, and then bought another business that's probably a shorter horizon 18 months ago. But I do a lot of search fund investing, a lot of gap investing, as Lou mentioned. And then I do a lot of what I call search fund second acts. So folks that were of my vintage that have bought and built and sold their company and are now out making other investments, either to run themselves or they're putting deals together and they're the lead investor. And I'm trying to ride their successful coattails with some good investments. I will take a breath and see what questions pop up.
Well, Dan, I'll ask you a couple of questions. So one, just take us back to when you made the jump. Were you married? What was your wife's perspective, if you were, on, doing this whole search thing? And then did you ever have any idea that, the outcomes and what transpired was possible when you did it, or did you have a lower expectation? So curious about that. And then also curious, the time period that you had to search. It sounds like it took you a while. A lot of companies were evaluated. Did you guys ever get close to, hey, maybe this isn't going to work, maybe we're not going to find the company? And what happens when you don't, because a third of searches don't find the company to acquire. So, what is it like if you're up against that,
Well, when we closed on StatLab, I think we had $8,000 left in our account, which Mike and I split for moving expenses to Dallas. So if StatLab wasn't getting done, it was game over for us. We had a deal probably 3 or 4 months before we found StatLab, where we were on the 10-yard line. It was a $50 million acquisition, a nice business. The seller pulled the plug on us. So we survived one of those. We didn't have the capital to survive a second one, and fortunately we didn't have to. To your question about when I started, my wife was very supportive. So I think she knew that if I went back into private equity, I wouldn't be as happy as what I could be if I went down the path that I was trying to go down. She was working at the time. She was paying the bills, and so providing health insurance. And I think that gave us, we had no kids. We now have 4 children. The first one that occurred during the search, but we didn't have a lot of overhead, and that was, that gave us a lot of flexibility. And then the reality is, I had a degree from Notre Dame and Harvard, and I could have failed. We were close to failing on our search, and if I did, I would have found another job, and that life would have gone on, and we would have had just as much happiness and joy had we not found StatLab. We did not expect. We did not expect to do as well as we did with StatLab. We really benefited from just the frothiness of the marketplace. When we bought the business, we paid about 7 times EBITDA, and we had 25 investors. We probably had a third of our investors passed on the deal, And of those third, I think half of the people said, you're paying too much for a distribution business. And that may very well have been right, but we didn't have a lot of options and we liked the business and we found something we didn't think a lot of. We should have thought more of as a two-person search. StatLab had two really well-defined jobs for Mike and I to do that were really meaty. So we could both stay busy. We could both get fulfillment. He was building a sales team. I was, rebuilding the supply chain and manufacturing. And, we had opportunities, and there were some opportunities in hindsight we looked at where there really wasn't two big roles for a couple, alphas that like to, get work done and move fast and, maybe don't always like to consult with each other on every little decision.
Okay, so there's a couple questions that have come up throughout, and if anybody has others, this would be the time for Q&A. Both initial ones are from Todd Boney. So one was, do buyers see search funds as less credible than a traditional PE firm? So I don't know if any of the three speakers have thoughts to weigh in on that one.
Well, since I'm on, I'll talk. I mean, we tried to get through the can these guys fund the deal pretty early on in the process. So we were shameless about, we had a brochure. I think it had, a page on who we were, what we wanted to do, and then like 8 pages of investor bios. And we would just say, if you want to talk to Bill Egan or whoever, then we'll connect you and he can tell you he's got the money. And oh, by the way, he owns a piece of the Boston Celtics. So you make a couple of those kind of comments and you try to get through the advisor. That was mostly for businesses that had an advisor involved. The common belief was that a pledge fund or a search fund that doesn't have the capital committed is not as likely to get the deal closed. So we just tried to be proactive on that point and get through it early. And we did not have any problems. We did not lose any deals because people thought we couldn't come up with the money. We lost them for a lot of other reasons.
Don Dow, do you have anything else to weigh in? Do you agree with what Dan experienced? Did you have a different experience?
Yeah, I guess, my experience has been when I engage with brokers or investment bankers who are running, processes to sell a business, they're a bit more cagey with regards to the fact that I'm a search fund because they know that my investors have a first right of refusal. And if they decide to refuse, then I'm in an equity gap position. They also know that I haven't done this before, so they're sort of wary to begin with. Now, the opposite side of the coin is when you're talking to a 75-year-old business owner who's run the business for 30 years and has had plenty of conversations with private equity funds and their investment bankers and knows what comes with that territory, the appeal of a, single, younger, more energetic searcher who isn't going to run the traditional portfolio play alleviates, some of their bigger concerns, which is around preservation of the business and future of the business than is sourcing capital. And I think, my market today is very different from Dan's market over a decade ago, in that capital is sort of everywhere these days. And I haven't gotten pushback from any, any single process that I've been a part of yet from a capital perspective.
Got it. Well, one other question that was received early on was, are search funds the private equivalent of a SPAC? So any of you can take this. Lou, if you want to take it, feel free.
No, we do nothing to do with SPAC. So I will say I'm not sure I could answer for the search fund side, but not the SPAC side.
Okay, we've got another great question. I'm sure a lot of people are wondering this. I can pull up the Stanford report if you guys don't have it top of mind, but I'm sure Dan and Dan will both kind of know. But what is the typical equity/profit split between the searcher and the investors?
So for a partnership, so the investor gets the right to invest in the deal, but not the obligation. Their initial capital that they provided gets stepped up by 50% and put into the deal. So If a searcher raises $500,000, basically $750,000 gets put into the deal as equity. They get a little bit of discounted equity. And then the profit share is 70-30. There are some performance hurdles on the 30% to the searcher or searchers. Usually that is 10% of that you get for closing the deal, 10% you get for showing up for work for 5 years, and 10% based on either some combination of IRR returns or cash on cash returns. There, you know, our model was a little bit different. It's so old, but now there's some preferred returns and some hurdles that you have to clear from like an 8% target to get into some of the equity. Maybe Dan would speak to the market today that's different.
The only
Yeah,
thing
I
I
think
would,
that, I mean, that construct holds, and Lou probably has a broader perspective than I do, but I think that construct holds. There's a little bit of variation for whether you're a solo searcher or a partner searcher, where the 30% that Dan alluded to is for a partner search, and as a solo search, it's 25 split into those 3 tranches. And then your point on the preferred coupon on the equity is it tends to vary deal to deal, but there is certainly a coupon that comes with that equity. So it ends up being, from a searcher's perspective, pretty expensive capital, but you pick the right folks, it's value added capital.
yeah, the only thing I would add to what Dan Hensetti is the performance piece, the third that is performance, whether it's a 1 or 2 person search, is generally vests over a 20 to 35% IRR hurdle, just to give you a sense of that. But 2/3 of the equity will vest between closing and time-based vesting.
Okay, I don't have other questions. If anybody else has any questions, feel free to put them in the chat now, or forever, hold them to yourselves. We have hit our time constraint. So everybody will get their CPE credit today. We'll make sure that if anybody has questions, we can circle at them after the event today. I want to thank FEI, thank the other steering committee members and sponsors. I want to thank all of our speakers, Dan, and Lou. And I appreciate our attendees. So thank all of you for attending on Cinco de Mayo. I think everyone's earned a margarita, and appreciate the time. You guys have a good day.
Appreciate your work on this.